Let's bring in Evercore's Roger Altman to discuss. Welcome back. It's always good to have you on our program.
Hey, Scott. Thanks for having me.
What's your takeaway from today?
Unadulterated good news. Think about it. Growth is strong. Commerce Department reported 3% over the past year. That's amazing 4 years into the recovery. Inflation headed straight to the Fed's target. Job creation, strong. Corporate profit outlook, as you just discussed a minute ago, strong. Dock workers strike over. Gasoline prices down. Hard to imagine a better macroeconomic environment than the one we have right here. And there are a lot of election implications of it, let alone other implications.
Sure, but people would listen to what you just said as you went down the list and say, okay, why in the world did the Fed do 50? And then why would they think that they need to continue cutting rates on the schedule they seem to be on? I mean, I know you know Larry Summers well. He says 50 was a mistake.
Well, I was on here, this network, just before the Fed made that decision and just after. And my own view, as I expressed it, was that it was an extremely close call as between 25 and 50. And I don't really think you can, with all due respect to Larry, I don't think you can really criticize the Fed, because if you think back to Powell's comments at Jackson Hole, he made clear that they felt more confident about the inflation pathway than they did about the labor market outlook, and therefore that we're going to tilt a little bit toward protecting labor markets, which is what they did by cutting 50. Going forward, I've heard a lot of commentary today on your show and earlier shows here about the Fed now reverting or getting back to 25 basis point cuts. That's my own expectation in the November meeting. I don't think they'll stand pat because, as Powell said, the time has come to ease monetary policy. I think they're ultimately heading toward a roughly 3 to 3.5% federal funds rate. And the pathway to that is probably going to be a little bit slow, but pretty steady.
You know, someone might also listen to that list that you went down, which listed so many different positives, and say, well, Roger must be really bullish on the stock market then. And you're actually not. Why?
Well, I wouldn't say I'm not bullish, but I think it's going to be hard for equities, at least between now and the rest of the year, the end of the year, to move up in any material way because they're already so high. They're at record levels. In a lot of cases, multiples are abnormally high. Not every case, but a lot of cases. And open market interest rates, as we see today, 10-year and so forth, are actually rising. In fact, the 10-year has risen about 40 basis points from its low. That's not trivial, which is not at the margin making it easier for stocks. So it's been an amazing year for stocks. As of a couple of weeks ago, if you annualize the S&P 500 for the whole year at the rate that it prevailed, rate of increase that it prevailed 2 weeks ago, it was going to be the best year for the S&P 500 in ages. So it isn't that the stock market isn't good; it's great, but getting up to a meaningfully higher from here over the short term, I don't see it.
You know, every time you're on, we talk capital markets, we talk M&A, we talk about your bread and butter at Evercore in some respects. And, you know, I had a conversation with the chairman and CEO of Goldman Sachs not that long ago, David Solomon, on his outlook for when this whole thing's going to pick up. Like, where are the IPOs? You just said the environment's so great. Stock markets are record highs. We still have no IPOs. I want you to listen to what Mr. Solomon said and have your reaction on the other side.
The environment's actually okay, I would say, for bank activity in our business. There are places where it's been accelerating. I think we've seen a real acceleration in debt capital markets activity, some meaningful improvement in equity capital markets and M&A activity.
When does somebody like David Solomon get to come on and say we're back?
Well, let's just focus for a moment on the M&A environment. It is improving, but 2024 is going to turn out to have been an okay year, but not an awesome year, although expectations for 25 are very high. And if you look at a variety of of early indications like conflict checks and engagement letters, risk backlog, and so forth, we think that expectation for a much better 2025 is logical. So the M&A outlook is pretty good. And I expect equity capital markets activities to be good also in 2025 because there's so much pent-up demand.